Right, good morning everyone. I'll kick off. Welcome, and we have good attendance this morning, and I'm really pleased to see that we've got about 30 in attendance, which shows that there's a good level of interest in the issues that we are on the point of just whizzing through during this webinar. I'm going to talk about broadly four things as time allows, and I certainly don't intend to go over and beyond 1 hour, and if anything, I'll try and bowl this presentation and get your feedback a little bit more quickly, because I know we're all very busy. So I'm going to talk about, if I can, four things. Firstly, the proposed exemption relief that has been put forth in a consultation paper released by FMA on 10 March, and on which submissions are due essentially the end of next week, but on which we need to get a draft submission through to the FSC board by end of tomorrow. So I'm very, very keen to just impart to you what I think should be the key themes of our submission on that very welcome exemption relief proposal, and of course what's in the proposal, and get your feedback both during and of course during today and over the course of today. Secondly, I want to touch on just the surprise and somewhat penal imposition of a 39% tax on really the bulk of employer contributions to DB schemes, a law change which took effect on 1 April this year, whereby most of those are now subject, unless and until we roll it back, and we're working hard, to a 39% tax rate, which is simply inequitable. Don't want to touch very briefly on some consultation issued by MB just days ago on dispute resolution schemes, and we should be actively engaging in that as a group of workplace schemes as well, and a few other minor points. So Hayley, I'll get you to move to the first slide. So the principal focus of today is the exemption relief and the ESCT issues, on which I'll be really, really grateful for feedback. And Hayley George of FSC, who you can't hear, but she's going to pipe up and prompt me if questions come through that require a response as I go. We're now 4 years into the FMCA regime, and each of your schemes has restricted status. Consequently, some really valuable compliance relief as important but lower risk contributors to the National Retirement Savings Pool. I've said this a lot, but I think the FMC legislation is in numerous respects really good law. Restricted schemes retain the same governance model they've always had. Their trustees didn't and don't need a manager license. They have no need for a separate supervisory trustee or any independent custodian. And the LITs, or as I like to call them, the professional directors, as a complement, have materially added value to scheme governance. So it's really good law. But in some respects, the law has been a pretty blunt instrument, as most of you know. It's impacting restricted schemes coextensively in some areas with the big end of town, the big multi-billion-dollar KiwiSaver schemes, in ways that don't quite pass a common sense test. So in early 2018, and I want to pay credit to Gavin Quegan, who I understand is in attendance today, although I won't be speaking, the FMA itself embarked proactively on a project that it called right-sizing obligations for restricted schemes, and it invited Workplace Savings, as we then were pre-merger, to share with it a list of identified issues and problems that merited regulatory attention, and we did so. We actually listed 22 pain points creating ongoing issues, as well as technical or indeed practical compliance concerns. In May 2019, FMA responded with some feedback on the issues that we had put forth. Essentially, I boiled the most material among them down to this table. There are 3 columns, a suite of issues that was acknowledged as meriting work and possible exemptions or law changes were, and 3 of them are being addressed with the pending exemption relief that we're talking to today. The need for DB schemes to, in some cases, produce fund updates when that need is triggered for a purely technical reason, which I'll get to very shortly. Quarterly reporting. 99 out of 100 quarterly reports from this sector are nil. They take a lot of doing. They need unanimous board approval. The timing requirements turn on a dime. We had to do something about it, and we are. DB schemes, there's a complete legislative lacuna, which is lawyer speak for there's just nothing in the FMC ledge about how DB schemes, as opposed to accounts-based schemes, should report to their members. Number 4 there has already been fixed, but we're talking principally about issues 1 to 3 today. Before I do, though, there's a whole lot of other stuff that remains a live issue for us as the Workplace Savings Committee of FSC, areas where the ledge just needs a little bit of tweaking to render it more appropriately workable for this sector. One of which is quite elementary. One of the requirements, moving to the middle column, one of the requirements under the FMC legislation when you do lodge, and this is of course your DC and your hybrid schemes, a fund update and a PDS for those of you that are still open to new members, is that those documents have got to be made publicly available, and the words publicly available denote having your own website. A number of you don't, and we need to have explicit acknowledgement in the ledge at some point that that's perfectly permissible. I'll gloss over 2. To be referred to MB and understand still a live issue, irons in the fire there. Moving to a 4-month deadline for the provision of annual confirmation information, which means annual member statements. That's really, really important. Overwhelmingly, this scheme operates according to an earnings rates rather than a daily unit price model. In order to produce year-end member statements, in practical terms, you as trustee boards need to have completed, certainly to the point of audit certification, your financial statements in practical terms lodged in annual report before you can really reliably dot I's and cross T's on the member confirmation information, because of course that needs to impart with precision the final post-wash up year-end earning rate. I understand that our entreaties there are getting a little bit of traction, and that is sitting somewhere within the MB machine as on someone's to-do list. So I'm going to turn now to slide 2, Hayley. The exemption relief, slide 3, that's the story, yep. When FMA responded to us in May 19 with that schematic, which I've just summarised in the last slide, there were a number of schemes where they actually expressed approval for in principle approval for the relief that we had sought from them, and just sought a little bit of information from the sector. And we did so in February 2020 by way of providing a little bit more information to inform FMA's priorities in terms of getting on and pursuing this fantastic initiative of making your lives just that little bit easier in certain of these areas. We worked out and we advised FMA that DB schemes caught, in inverted commas, by the fund update requirement would save somewhere between $3,000 to $5,000 per annum conservatively if they were relieved of the fund update obligation. It would lead to a reduced compliance burden and no material negative impact for members who, of course, overwhelmingly are on the receiving end of or are accruing defined benefits, which are calculated independently of year-to-year investment returns. We pointed out that the key empiricals are already set out in the annual report anyway. We all talk in annual reports about usually glowingly, about the scheme's net year-end earnings rate and about broadly the asset strategy, the way the schemes are invested. We also guesstimated that schemes would save up to $1,500 per quarter, not to mention all of the not inconsiderable time cost if relieved of the nil quarterly reporting obligation. We also pointed out that the very tight, and I'll talk to it shortly, 10 working day deadline for producing those documents causes quite major headaches. We lastly urged that the ledge move to acknowledge, or that exemption relief move to acknowledge, that what DB schemes should be explicitly permitted to do is provide benefits-based annual confirmation. These are your entitlements, instead of the transactions-based confirmation information requirements that are prescribed in the FMC and really contemplate an accounts-based KiwiSaver or defined contribution scheme. We pointed out that that would address really an obvious omission from the FMCR. So next slide, Hayley. Happy days. that's the one, we have some initial relief proposals. I hope the first of several in each of 3 areas. So the FMA is contemplating, which I hope means proposing, exemption relief, whereby there would be no requirement for defined benefit schemes to prepare fund updates, simply because, and this is how some of you are caught, some members either haven't yet qualified for pensionable service and salary-based retirement benefits. In other words, they're at that younger end of the age spectrum whereby they remain eligible in the here and now only for a benefit based in some way on their own contributions plus scheme investment earnings, and or there are members, and there's some of this happening, some of it's historical, relates to old salary sacrifice arrangements and things. Members have voluntary accounts which are truly ancillary to the main benefit structure of the scheme. In other words, they've contributed themselves through payroll a little bit over the odds just to supplement the defined benefit. And those voluntary accounts are impacted by investment earnings. If there's as few as 2 or 3 such members, then and technically at least the scheme is caught, and a number of you, having been thus caught, are producing year-to-year fund updates, which is something of a nonsense. Quarterly reporting, the FMA is proposing to delete the requirement for quarterly, as I mentioned, usually nil, reporting about limit breaks and related party transactions. Just pausing briefly, limit breaks are material departures from permissible asset class ranges or permissible asset classes, and related party transactions are, of course, those duly certified transactions, typically with an admin manager or paying a licensed independent trustee's fees that expose the scheme to cost or risk and need to be duly certified before they're entered into. We're moving now, we should all be doing cartwheels, to event-driven reporting, which means filing the quarterly report only if the scheme has something to report. And annual certifications, those can of course be nil. So there's an annual look back, which is much more, I think, balanced, given the size and shape of the largely, of course, legacy workplace savings scheme sector. Confirmation information for DB schemes. This misalignment is now being addressed in the proposed exemption relief. FMA are proposing, indeed, as we requested, that those schemes be required only to provide benefits-based reports to members at the year end that are actually fit for purpose. But on that last point, FMA have put forth some alternative options and some alternative templates. And it's really important that we do engage on those, because I think we have to be careful not to over-engineer these requirements. And I think there's a base level of reporting that I think more than suffices. So Hayley, next slide. Have we had any questions to this point? I'll assume not. The fund update relief. Sorry, Hayley. Yep.
No questions yet.
Good, thank you. So the fund update relief. Look, in the case of a defined benefit scheme, even if there are people who are still below the magic age, be it 50, 55, or even a prescribed length of service for qualifying as of right when they resign for a final average salary type benefit, most will already have qualified or can reasonably expect in due course to receive a salary and pensionable based service benefit. So in other words, a defined benefit when they eventually leave service. The FMA consultation paper acknowledges that comparators about how the scheme is performing, and the policy intent there is largely to help people who have member investment choice compare funds, are really just not helpful for members who find themselves in DB schemes, who can expect, all things being equal, to receive a formulaic end benefit underwritten by the employer, and who of course do not have member investment choice or any particular portability between schemes. So the proposed exemption relief acknowledges that the fund update requirement is over-regulation, especially as the relevant schemes in practice disclose, as I mentioned, net returns and annual reports anyway, and members have no investment choice. They're proposing that the fund update obligation be lifted where a scheme only, and the words used in the consultation paper are only, has a few members who are still in the course of qualifying for a defined benefit or may have voluntary ancillary accounts. I'm suggesting that in reply we should probably turn that on its head just a little bit and say the exemption wording needs to be much more directive. It needs to prescribe that a DB scheme is subject to the fund update requirement only if it's a true hybrid scheme with a cash accumulation section. In other words, a section, the core proposition of which is that the members in benefit, and these are of course the sections typically added by amendment from 1990 and subsequently, whereby the members in benefit is simply the accumulation of their own and the employer's contributions plus or minus investment earnings, and those should be caught, and that's because those members are receiving benefits calculable in their entirety by reference to year-to-year investment earnings. The proposed exemption condition is that the annual report needs to include the net return and the investment strategy outline. I'm proposing that we respond that that's perfectly acceptable, but I think that it'd be important to seek clarification that the required net return information is actuals for the most recent year only. We don't want to have to re-engineer annual reports with the practical equivalent of the relevant component part of a fund update, whereby we're comparing against a market index, we're looking back 5 and 10 years, and we're looking at gross and net and bits and pieces such as that. We just want the net return, that's what's relevant, and for the most recent year only. And as to the scheme's investment mix, I think we should respond that the target mix suffices. So consistently with clause 69 of schedule 4 to the FMCR, we just, as most do anyway, we just tell members what in snapshot terms the benchmark asset allocation was as at the balance date in question. So I'll just pause there and see whether there's any feedback just momentarily. I'll assume silence represents assent, and what I'm happy to do, and in fact what I have done, is circulate a draft overnight. I've got a Q&A here. Here we go. This is fun. Looking at your proposed hybrid carve-out, would a voluntary contribution account in a DB scheme qualify as a cash accumulation section in your view? In my view, no. I want it to be, I think we will make the point very clearly that when we're talking about a cash accumulation section, we're talking about one, the core proposition for which is it'll be Schedule X to a trust deed. It is the section to which every new joiner, commonly for the past 30 years, has been joined to the exclusion of any defined benefit entitlement. So no, we wouldn't characterise half a dozen voluntary accounts with an aggregate of a few tens of thousands in them as being a cash accumulation section. They are truly ancillary bolt-on. I hope that's helpful. Have I cleared that Q&A? 2, here we go. Thanks. You're welcome, David. I'll move to the next slide, Hayley, if we can. So quarterly reporting relief, key points there are that FMA is considering relief for all restricted schemes by moving to positive quarterly reporting obligations as well as an annual reporting obligation. By positive, what that means is that quarterly reports would only need to be provided if a material limit break has occurred or a related party transaction certificate has been given. I cited overnight a table produced by the secretary to one of our member schemes that shows that for the last umpteen years running, there's been sort of 3 or 4 positive or affirmative reports in aggregate, which kind of says it all. An annual report would need to be provided, though, stating whether any material limit breaks or related party transactions have occurred during the year, and that would include a nil report. To be clear, before I dive into the detail and how I propose that we should respond, the provisions requiring managers of restricted schemes to provide an immediate report to FMA in the event of a limit break which remains uncorrected for 5 or more working days are preserved intact, as I think they should be. and we're not getting relief from section 1735 of the FMCR, which requires the licensed independent trustees consent to any related party transaction certification. What is proposed, given that there is a considerably reduced risk of related party transaction harm and considerably more, I suppose, active supervision of third-party fund managers within restricted schemes, is that we will move to a nil quarterly reporting exemption. And I think, obviously, we should say that that proposal is strongly supported by stakeholders in this sector of the industry. But although the discussion paper goes on to say, we understand there are particular characteristics of restricted schemes that may mean providing reports within 10 working days of each quarter end is especially difficult, particularly when it comes to eliciting core compliance information and the requirement to get all trustees' approval of the reports and dual sign-off from the chairman and the lit before anything goes out, or the lit and one other trustee. It acknowledges that that's a major problem. It kind of then leaves it hanging and doesn't go on to affirmatively propose a little bit of timing relief. So subject to feedback, I'm proposing that as a group of schemes, we should be saying that the quarterly reporting deadline, if indeed the affirmative obligation to report is triggered, should be extended from 10 to 20 working days for limit break reports certainly, because it typically takes 10 or almost 10 working days just for trustee boards to receive the fund manager's raw data. And 20 working days, which of course is less than a month, is still timely in objective terms, and it just would take a great deal of pressure away. For consistency, and as the two reports are routinely combined, the reporting deadline, should I suggest, for related party transactions reports, again, if the affirmative reporting requirement is triggered, should also be extended to 20 working days. So that's the guts of the submission. I see we've got another Q&A. Happy days. Strongly supported. Thanks, Mike. Cheers, Bruce. Thank you for that. Another issue which is kind of ancillary to those issues is actually there is a this issue is essentially self-mitigating because of there's sort of really close review of fund managers and around related party transactions, of which there are very few. But I think it's a really important point of principle that you're not required to chuck a whole lot of time and resource quarterly at something which is really just confirmatory of the obvious, which is that relevant reports are few and far between. So I'll move to annual confirmation information for DB schemes. Next slide, Hayley. Probably a key point here is that exemption or a law change is a logical necessity. The information mandated by Regulation 70 capital B of the FMCR for every scheme and every punter, which is opening and closing balance and contribution credits, is simply irrelevant for a member, particularly a pensioner member, but indeed for any active member, with exceptions of a DB scheme. So we've got to move to a benefits-based reporting requirement, and that should be, of course, supported. The FMA provides a couple of example forms towards the back of the consultation paper. They're anonymised and lifted and shifted from actual industry examples. They're really good, and they do credit to the admin manager that yielded them to doubtless Gavin. But each of them does more than should be compulsory. It does so as a member service. To my mind, defined benefit schemes should be required by law to show in the confirmation information only the projected retirement benefit entitlements at age 65 or another scheme standard qualifying age such as 60, and the current leaving service benefit entitlements. In each case, in snapshot terms, based on the member's current salary for scheme purposes as at the year end. There's a sense in which FMA seem to be commending that they should also include the disablement benefit and death benefit calculation, and possibly even details of nominated beneficiaries put forth to be considered for receipt of a death benefit, for example. And while those are nice to haves and good to haves, what amounts to mortality and morbidity insurance and ancillary details such as who you have most recently nominated to receive either or both such benefits don't go to the core of your entitlements, and they are not mandated for defined contribution schemes. So by analogy, shouldn't be mandated here. One last point is that FMA have said in the paper they don't consider it appropriate for this relief to extend to accounts-based master trust plans, of which there are a meaningful number. Those are the plans that have migrated, usually pensioner groups, from standalone DB schemes that were too small to have a reason for being into, in functional terms, defined benefit structures comprised within a master trust, whereby in order to comply with the way that the master trust operates and is governed, people have notionally their own accounts with contribution inputs and outputs, but really they're on the receiving end of a benefit promise. So I'm not sure that there's any in principle reason for life benefit plans to be denied equivalent relief. Got a comment here from Helen McKenzie. Thanks, Helen. Strongly support the recommendations outlined. Going back as a collective of member schemes rather than individual submissions is my preference and that of my chairs. Thanks, Helen. I do tend to concur. It's really important that we try and speak with one voice, having elicited urgently, I know, and I do apologise, some feedback from member schemes as to how we can help each other put our very best foot forward as an industry. Certainly that's the purpose of these sorts of webinars and of the internal consultation within FSC, who have really lifted our game in this space because they have concentrated our minds on the need to consult. So yeah, I agree, and I'm very happy to share, Helen, the draft submission. Philippa supports the concept of benefits-based annual confirmation. For the ages, we tend to refer to the member age and pick 3 retirement ages that are relevant. Often today, people on the receiving end are already over 60 or 65. Indeed, they've already superannuated. That's a really good point. And I will take that away and think about how we at least acknowledge that in reply to FMA. So if there's no further feedback on those issues, what I propose doing is perhaps, Hayley, we could go as far as sharing a little bit more widely than the Workplace Savings Committee, a good many of whom are listening today, but actually share to everyone who's in attendance today, not only these slides, but also the working draft exemption submission from FSC, because it's really important that as many of you as you can are able to have a look at that and let us have any direct feedback, which I would very much welcome. So I'll move on, Hayley, to a reasonably unpleasant surprise that workplace savings schemes, in particular defined benefit schemes, received pursuant to a law change which was not just figuratively, but more or less literally buried in a recent tax amendment statute. To date, the rate of ESCT on, whoops, there goes my light. Better wave my arms around. That's hard case. The rate of ESCT on pensioner deficit and expenses funding towards defined benefits, of course, typically pensions-based scheme, has been 33%. In practice, what people do is, to the extent that they're unable to reliably attribute contributions to members, if there are any, who still remain on the active member side of the ledger, in relation to whom there is the facility to pass through tiered ESCT rates, what schemes do in practice, and it's mandated for them in the case of pensioner liabilities to date, is pay 33% withholding tax on those pensioner liability contributions, on deficit funding and on expenses funding, because the latter two are by their nature unallocated or not able to be reliably allocated to individual employees. Effective 1 April 2021, it was both punitive and a surprise to all who read it, literally discovered it for my part. The ESCT rate was increased, so it's already increased. We're looking in the rearview mirror to 39% for those contribution streams. It's mandatory when funding benefit liabilities in respect of past employees, which of course means ex-employee pensioners and by implication surviving spouses or other family members. And additionally, it's more or less forced on contributors in relation to unallocated deficit and expenses funding. Hence, those two are now taxed at 39%. It's a significant, and in gross terms, close to 10% sponsor cost increase. So we have let rip. We've launched strong submissions to Inland Revenue seeking a rollback. The ESCT top rate of 39% is intended to impact individuals with superannuation inclusive packages of over $216,000 per annum. Translation: a couple of people in a C-suite, or maybe the odd very senior executive. We did a lot of work, and I really want to commend the admin managers that swung in and helped support a really well-crafted and well-received, to be fair, letter. IR have engaged very constructively, who looked at exactly what is the average employee member salary across as many surveyable schemes as possible, and we managed 33. And it's south of 100,000. Indeed, it's $96,863. When you look at what is the most equitable, or in principle the right ESCT rate to apply with respect to the pensioner complement, it's easy and probably wrong in principle to assert that it should be the marginal tax rate, or aligned with the income that those pensioners now receive in retirement in aggregate. I think that's probably not quite the right analysis. I think the better analysis in principle, given that the pensioner's deferred rem, is what actually were pensioners earning on average when in the saddle. And even there, the available data, albeit limited, on pensioners' salary immediately pre-retirement, and that will of course typically be at the apex of a pensioner's career, is that pensioners average 109,000 just before retirement. So I've got another question. Oh, Gavin, I'll loop back to that feedback about the Master Trust. Yeah, I will come back to that, Gavin. Thank you. This is a big issue because pensioner liabilities are now at 71% as at most recent available balance dates, as a pan-industry percentage across DB schemes. Of whom there are 53. As of course, employee members inexorably move further over to the pensioner side of the ledger, and the majority of schemes are in deficit, and we can expect deficits to be more and more a feature going forward, as volatility isn't likely to evolve the right way. Aggregate annual net of tax employer contributions to this sector are around $30 million at last count. So this is a material issue. And one of the things we had to roll back on was the perception, wrongly, that surviving, of course, almost without exception, legasied DB schemes are sort of the top hat variety, are provided for white collar folk. The biggest DB scheme sector by size and both member numbers and funds under management is in fact heavy industry. So most remaining active members and probably a plurality of retired members probably wore overalls to work, followed by clergy of all people, and then financial services. So it's quite an important issue of principle. I'll just loop back to Gavin's feedback on the Master Trust, because I certainly don't want to be too assertive. So look, they're a pretty small complement. This is going back to the annual confirmation information for schemes which are defined benefit. For a life benefit scheme, Gavin's perspective is it's important for the member to know the dollar value of the account balance on an ongoing basis. This, for example, enables the member to know how long the payments will last, and the member can put pressure on the employer for top up if necessary. Understood. And I think as I'm not really proposing to go any further than just say in principle, master trusts should be enabled to invoke the relief, but it's not a big issue. Happy to redact that ancillary point. So I'll turn to slide 2 on defined benefit schemes. When obviously an issue here is that even the previous 33% rate probably erred on the high side, given the frequently lower ESCT rates that will have applied when pensioners were in service, and a 39% tax rate is simply inequitable in my view, not only because of the very low proportion of taxpayers generally to whom the top tax rate will apply, but also because when still employed, none of the current pensioners in the largely legacy and pensioner dominated sector will have had a 39% rate applied to them. Yeah, and I have, Philippa, we have touched in the submission to IR on the GSF dynamic. I'm very happy to share with you the stats and the observations that we shared with the respondents in that regard. I suppose we made the point that, I guess from the outside looking in, I would have thought that GSF contribution obligations imposed on employers would come from vote XYZ or vote ABC, and this will impact available. It could impact cash flow. I don't know, but anyway, we've made that point. I'm very happy to share with you the relevant paragraphs in a submission. The focus of which was principally private sector schemes, of course. So we've had very constructive ongoing engagement with IR officials who are listening with open minds, which is a credit to all of them. They have no quarrel with the recent characterization in a newsletter of this issue as having created negative impacts and unfairness, which significantly increases the cost to employers of maintaining schemes, risks becoming a major impediment to employers appropriately funding schemes, and indeed may cause immediate cash flow issues in extremis in some cases. It's early days, but I have some guarded optimism that we can sustain our case as to gross over taxation and the appropriateness of a rollback. And indeed, I would hope that the live issue becomes in fairly short order one of timing and retroactivity. So we will keep you informed. I think I've got another question. Should scheme now be paying 39% or retain 33% while this issue is sorted? As we speak, caller, the rate of ESCT payable on pensioner funding, and in practical terms, as I said, deficit or otherwise unallocated expenses funding is 39%. So that question goes to the point about this law change giving employers inappropriate pause for thought about the tax efficiency / the appropriateness of contributing on an ongoing basis, given that in principle this issue should really be sorted in fairly short order. It's overreach and it is punitive. So I'm just going to turn now I'll leave it there. I'm going to turn now just touching very briefly on another issue which popped up onto the Workplace Savings Committee's radar in the last few days. Hayley, if you will, the review of the dispute resolution scheme rules. MB has identified a range of inconsistencies in the rules governing how people engage with the 4 approved dispute resolution scheme providers: the Banking Ombudsman Scheme, Insurance and Financial Services Ombudsman, I think it is, Fiscal, Financial Services Complaints Limited, and FDRS. They have a whole range of different rules around permissible financial caps, weekly alternatives, the primary financial cap, how long it is that an issue has to be deadlocked before they are able to engage, issues about when and on the basis on which they can engage on complaints. Despite best intentions, am barreling towards the end of 60 minutes, so I won't burrow into some of the intricacies, but suffice to say the discussion paper sets out some very carefully considered and very well presented proposals regarding financial caps for bringing a complaint and rendering those more consistent, limits on compensation which can be awarded, the timing of membership and its impact on jurisdiction, and those applicable time periods which impact when and how a scheme can hear a complaint. Submissions close on 6 May, and certainly Fiscal will be engaging. Sorry, FSC will be engaging. Please can members reach out to Carissa Pirano, who is shepherding a draft submission on these issues through, if you would like to contribute your viewpoint. It's really important that we do so. One of the proposals is that the cap be raised from 200,000 to 350,000, and there's going to be obviously recommendations around just regularising the period for which a dispute has to be deadlocked before you can engage the dispute resolution scheme. There's a very wide variance there, and the proposed option is that the time period be limited to 1 to a maximum of 2 months. So that's an important issue in principle with which we should all be engaging. I just wanted to touch last of all, before we sort of threw open the floor on, and one more Q&A. Going back to annual confirmation information for DB schemes, neither example in the FMA consultation works for retired members in receipt of a pension. Is tailored relief also required for such scheme participants? That is a really good point. That's an excellent point. So we need to clarify that. Of course, numerically, most of the recipients of annual confirmation information, inexorably all of them, are going to be actually on the receiving end of a pension. So what is it that they should be receiving? I guess essentially it's as at balance date, this was your monthly and annual pension entitlement. Do we think the required information to be provided for pensioners should include 100% commutation benefit figure, if applicable? My inclination would be that that information is explicitly available on request, pursuant to, I think it's 53 capital A of the regs, and probably should remain a request disclosure item if we're talking what needs to be mandated. But that's really good feedback. Thank you, David Ireland, for pointing out that pensioners should really just be given in snapshot terms a reminder of the level of the pension, full stop. The other ins and outs, they're all in the rear view mirror. So we'll certainly make that point, and hopefully, Hayley, you can collate and let me have this written feedback. Yeah. I just wanted to touch last of all, and there's no slide dedicated to it, on just the various other irons in the fire that I alluded to earlier, that we're keeping a weather eye on. We are keen to get ongoing feedback on the need to address the reality that a great many schemes don't have websites, and therefore get oh, you're welcome, David. Therefore get some feedback on the need to, I guess, acknowledge in practical terms that publicly available in this sector really should be loaded to disclose. End of story. I won't dwell further on those other issues because I'm getting really good engagement in terms of Q&As. Tim McGuinness, better to have actual rather than target investment mix. Let's discuss. I would have thought in principle target provided more meaningful information, particularly 3 or 4 months after the event, and is sort of given implicit primacy elsewhere in things like offer documents given to incoming members of a defined contribution scheme. So I guess in response to your question, my personal view is that target investment mix is probably the more appropriate on balance. Should we enable either? Let's have a chat about that over the course of, and I'll receive a bit of feedback on that over the course of today. We certainly don't want to have to mandate both wagon wheels. Another item of feedback, quarterly report has always been combination reports and related parties, so prefer same timing. Indeed, that's been the templates that we have produced, and that certainly is what we commend, that if there's timing relief given in relation, as I think there needs to be, to relief around limit break reporting, because there's such a negligible time frame between receipt of the raw data and having to lodge the duly approved report. We're better to make it consistent, because we don't want to have to divvy up reports. I think that might be all the feedback, and I really appreciate those responses. I haven't done justice to each and every one of them, but that's really good engagement. And what we'll do fairly toot sweet now, Hayley, is, as I say, circulate not only these slides, but the working draft submission, so we can get these points in. Any general feedback, Q&A or otherwise? I don't believe in meetings expanding to fill the available space. There is a school of thought, just while people are deliberating, that there's no logic. I'm not sure I agree with it, but there's no logic in setting any minimum or prescriptive requirements for DB schemes confirmation information, as there's no evidence these schemes are not already conforming to a really good standard. And in any case, all that's needed on one view is for members to be able to ask for details of their expected benefits at any reasonable time, a requirement already addressed in Reg 53A. I think there should be a push communication every year. I think members should be told proactively, these are your entitlements in snapshot terms. I think what we need to engage on is making sure that when told via an exemption condition what it is that DB schemes annual confirmation information must contain, that we speak with one voice on making sure that the mandatory minimum component parts of the annual confirmation information are kept to a minimum, and that we acknowledge the need for those reports to be different in kind as between actives and pensioners. Have there been any developments on extending the 3-month annual confirmation requirement to 4 months? Gavin might like to chime in, but I think the sense I'm getting, albeit several removes, is that is under consideration. Another questioner would suggest both target and actual allocations in order to show how the scheme's assets have been managed against the target. That's fine. Yeah, that's good feedback. That gels with Tim's feedback. It's probably not a hardship. The raw data will of course be available. So let's look at that. I think what's more important in principle is there just be a year in question look back. So if we're all collectively comfortable with both targets and actuals, then we should acknowledge that that would be perfectly appropriate. Gavin, thank you. Gavin confirms in practical terms my understanding that it is a work on. This is the 3-month deadline for annual confirmation, harmonising it with the 4-month deadline for financials and annual reports, which would really make everyone's lives a great deal easier, as evidenced by last year in particular. But the timing is unknown. Look, really good feedback on just to the effect that was a really helpful submission session, and I'm really pleased to get that. This is one of the areas where FSC's really lifted our game. The attendees, most of you were workplace savings stalwarts and still are. Merging into FSC was good for speaking with one voice, and it's really lifted our game in terms of not just the technologies, but also just disciplines around consulting on submissions, as we're doing this morning, and around making sure that that submissions come through in consistent formatting, and that are broadly representative of as many views as possible. So this has been, again, really helpful. I'm going to just pause for 10 to 20 seconds and make sure there's no further feedback, but I'll then assume that we're good to go, and we will, in a matter of moments, Hayley, share with you both the slides and the draft submission. The deadline for responding on the proposed compliance relief is 21 April, but in terms of the process which we have signed up to, which is therefore supported, we need to get draft submissions to the FSC board for its review within a set period before any submission deadline. And the way that shakes down on this one is, again, with apologies for the last minute nature of this consultation, end of today. But the submission has already been through a couple of rounds of feedback within the FSC Reg Committee, although it's fair to say that understandably, because that committee's remit is retail schemes focused, not a lot emerged from that process. So most of what you're on the point of hopefully having a read through has come from yours truly, and it is nonetheless representative of a whole lot of work that we did up front beginning in 2018 as a restricted schemes complement. So really look forward to your feedback, preferably by way of direct edits. Thanks everybody, and have a great day.